Silver investors, the bond market just blinked, and the Fed didn't. That is the entire story in one sentence. Today, rate signals flipped in a way that screams policy trap, and almost nobody is talking about it because it isn't dramatic enough for the front page. No bank run, no headline crash, just a quiet, mechanical shift in yields that tells you the system is creaking under the weight of debt, and the people in charge can't admit it without detonating confidence. Here's what happened, clearly, in the first 15 seconds. The Fed is still posturing higher for longer, but the rates market is starting to behave like cuts are coming anyway. Not because inflation is conquered, not because everything is fine, because the economy and the debt load are starting to look like they can't survive another lap at these interest costs. That contradiction is your signal. That contradiction is why silver matters right now. Welcome to this channel. In this episode, we're going to unpack the rate flip that hit today, why it locks the Fed into a no-win corridor, and how that changes the risk profile for silver as we head toward 2026. Let's start with the today part, because this isn't a textbook lecture, it's a live setup. If you only look at the Fed's words, you'll miss it. The Fed can talk tough forever. The bond market has to price reality. And today, the bond market started pricing a future where the Fed is forced to ease into weakness, while inflation pressures are still sitting there like embers under ash. This is the part most people misunderstand. When the yield curve starts to move from deep inversion toward normal, that's not a victory parade. It's often the final act before recession becomes obvious. Deep inversion is the warning. Uninversion is the consequence. It's the market quietly saying, the cutting cycle is coming. And the cutting cycle usually arrives because something breaks. Now, why is that a big deal for silver? Because silver doesn't just trade as a metal. In the wrong macro environment, it trades as a verdict. A verdict on credibility, a verdict on purchasing power, a verdict on whether policymakers can thread the needle without stabbing the currency. The Fed's box has 3 walls, and all 3 are moving inward. Wall 1, inflation risk. Yes, inflation cooled from the peak, but cooling is not reversal. Prices didn't go back down, they went up less fast. That means the new price level became the baseline. Rent, insurance, services, these categories don't collapse just because the CPI headline gets friendlier for a few months. Sticky inflation is the quiet enemy because it forces central banks to stay restrictive longer than the economy can handle. Wall 2, the real economy. Higher rates don't hit instantly, they hit in waves. First, froth comes out of speculative assets. Then refinancing gets expensive. Then defaults start climbing. Then layoffs creep in. Then credit conditions tighten. Then demand softens. This is why the most dangerous part of a hiking cycle is often the part after the hikes stop. The medicine keeps working after the doctor walks away. Wall 3, the debt machine. And this is the wall people avoid talking about because it's politically radioactive. The government has to roll over enormous piles of debt constantly. When yields are low, rolling over debt is annoying. When yields are high, rolling over debt becomes a compounding interest trap. Every time mature debt gets refinanced at higher rates, the interest bill balloons. The system starts borrowing to pay the interest on previous borrowing. That's not a conspiracy, that's arithmetic. So what does the Fed do inside this box? If they keep rates high long enough to prove they're serious about inflation, they squeeze the debt machine and the real economy at the same time. Interest expense rises. Corporate stress rises, consumer stress rises, political pressure rises. Something breaks and the Fed is blamed for it. If they cut rates early to protect the debt machine and stabilize growth, they risk reigniting inflation and weakening the currency. Confidence slips. Real yields fall. People start asking a dangerous question. If the currency loses value while the government borrows more, what exactly is the safe asset in the system? This is what Fed trapped actually means. Not that they're evil, not that they're stupid, that they've engineered a situation where every exit door triggers an alarm. Now let's talk about the bond market, the quiet confession. Most people obsess over stocks because stocks are loud. Bonds are not loud. Bonds are relentless. Bonds don't care about narratives. Bonds care about cash flow, inflation expectations, recession odds, and default risk. When bonds start moving in a way that contradicts the Fed's public posture, you pay attention. Today's shift is part of a larger pattern. The market is beginning to price a pivot that the Fed is not ready to admit. Certain yields stop climbing. Parts of the curve flatten or roll. Forward expectations lean toward easing. It's subtle, but it's the kind of subtlety that moves trillions of dollars before social media notices. Here's the psychological warfare angle. The Fed tries to control expectations through language. Higher for longer. Data dependent. We will do what it takes. Fine, but expectations get controlled by outcomes, not speeches. If the economy weakens enough, the Fed cuts. If financial stress grows enough, the Fed injects liquidity. If political pressure becomes intolerable, policy bends. The bond market knows this. It prices the likely behavior, not the brave words. And when the market prices cuts while inflation is still sticky, you get a toxic cocktail. Easier financial conditions before the inflation fight is truly finished. That's when hard assets start acting like insurance again. But silver is not just gold's sidekick. Silver is a two-engine aircraft. One engine is monetary fear. The other engine is industrial demand. Gold is the classic monetary metal. Deep liquidity, central bank buying. It's the conservative shield. Silver is the smaller, more volatile market with a split personality. It behaves like a monetary metal in moments of stress, and like an industrial metal when manufacturing and electrification demand accelerates. That means silver can get punched harder on liquidity events, and then rocket harder when the narrative flips and capital rushes for an exit. That volatility scares weak hands. It rewards prepared hands. Now let's put the debt spiral into plain language because this is the heart of the trap. Imagine you have a credit card balance so big that your minimum payment is growing faster than your income. You can cut spending, but that hurts your lifestyle and triggers panic. You can raise income, but that takes time. Or you can open a new credit card and transfer the balance, kicking the problem forward. Governments prefer the transfer. It's politically easier. The bill gets paid later. The pain gets spread out. Now scale that to a nation. When interest costs rise, every refinance becomes more expensive. Every new deficit becomes more expensive. The Treasury issues more debt to cover spending and interest. If rates stay high, the interest line item becomes a monster that eats the budget. If rates fall, the relief is bought with easier money conditions, risking inflation and currency dilution. Either way, purchasing power is the long-term casualty. And purchasing power is what silver is built to defend. Here's the shocking truth that gets buried under "inflation is coming down" headlines. The price level is still elevated, and the system is addicted to spending. Even if inflation is only 3%, compounding at 3% on a permanently higher baseline is still theft over time. It's slow. It's quiet. It's deadly to savers who sit in cash and pretend the war is over. So when the rates market signals that the Fed will eventually have to ease, silver doesn't need the next CPI print to move. It needs the market to internalize that the final solution is almost always more liquidity. And this is where you need to separate two different kinds of cut. There's the good cut, cutting because inflation is defeated and productivity is booming. That's the fairy tale. That's the soft landing dream. Then there's the bad cut, cutting because cracks are spreading and something is about to break. That's the historical pattern. The uninversion of the curve often lives in the second category. It's the market whispering, the Fed is going to cut, not because it wants to, but because it has to. Now let's talk about what usually breaks first. It's rarely the obvious thing. It's rarely the headline bank. It's often a corner, commercial real estate refinancing, regional bank balance sheets, corporate credit spreads widening, consumer delinquencies creeping, government auctions getting softer, foreign demand for bonds weakening. The system is a web. Stress shows up where the thread is thinnest. And here's the part that should make your stomach tighten. In a high-debt world, the solution to stress is often the same solution that caused the inflation problem in the first place. Liquidity, emergency facilities, quiet guarantees, backdoor easing. The kind of help that doesn't get labeled QE on the press release, but behaves like QE in the plumbing. When that happens, the dollar can wobble, real rates can fall, and silver can reprice violently. Now, before you get excited, you need to respect the path. Silver is not a straight line. Silver is a fight. In a tightening environment, silver can get smashed with everything else because it's liquid and it's easy to sell. In a panic, people sell what they can, not what they should. That's why silver dips can look irrational. That's why paper price can detach from physical reality. That's why premiums and availability become the real signal, not the headline spot quote. So what do you do with this? You don't try to outsmart the Fed day by day. You build a framework. Framework step 1. Stop thinking in single-week outcomes. If your horizon is 2 to 5 years, you care about the trajectory of debt, the likelihood of policy mistakes, and the trend in real yields. You care about whether the system will be more stable in 2026 than it is now. Ask yourself that honestly. Framework Step 2. Scale, don't slam. The market's job is to shake you. The system uses volatility as a weapon because volatility creates emotional decisions. If you deploy all capital at one price, you turn every dip into a crisis. If you scale in, dips become entries, not existential threats. Framework Step 3. Choose your exposure with your nerves in mind. Physical metal is slow and stubborn. It doesn't get margin called. It doesn't flash red on a screen every second. Paper vehicles, ETFs, miners, leveraged products, can amplify gains, but they also amplify the market's ability to bully you out of position. The more leverage you use, the more perfect your timing must be. And timing is the game the system wants you playing. Now let's address the debate that always shows up: gold versus silver. Gold is the base layer. It's the anchor. It's the metal central banks hoard when trust erodes. It usually leads in the early phase of stress because institutions move there first. Silver is the accelerator. Smaller market, bigger swings, more emotional participation. It can lag gold at first and then suddenly outrun it when capital realizes the same macro logic applies, and industrial demand adds a second tailwind. In other words, gold is the conservative insurance policy. Silver is the high beta expression of the same fear, plus real-world consumption. So why is this today signal so important? Because it's confirmation that the narrative is splitting. The Fed is still selling discipline. The market is starting to price rescue. That split is where regime changes begin. The split is where capital starts preparing for a different world than the one being described at the podium. And once capital prepares, it doesn't send you a warning letter. It moves quietly. Now let's make this concrete with the timeline that usually plays out, because history has a rhythm. Phase 1. Denial. Inflation is temporary. The economy is strong. We can hold rates high without breaking anything. The public is told to relax. The market is told to trust. Phase 2. Stress. Debt service bites. Refinancing pain spreads. Credit tightens. Defaults rise. Layoffs appear. Something in the plumbing squeals. The Fed keeps talking tough, but the tone begins to soften. Phase 3. Pivot. Cuts begin. Facilities appear. Liquidity returns in disguised forms. The narrative flips from fight inflation to protect stability. Phase 4. Consequence. The currency weakens, real assets reprice, and people who stayed in cash discover that stability was purchased with dilution. We are not at the end. We are somewhere between denial and stress, with early signs of the pivot being priced. That's why the rate signal matters. It's not a single data point. It's a directional tell. Now here's the cliffhanger you need to sit with. What happens if inflation doesn't fall fast enough, but the Fed still has to cut because debt and growth are cracking? That is the nightmare scenario. That is the both sides lose scenario. That is when silver stops being an optional asset and starts being a question of exposure. How much of your wealth is anchored to something the system can't print? Because here's the ugly truth. Austerity is rare. Politicians don't get elected to cut spending. They get elected to promise. And promises cost money. When the bill comes due, the temptation is always to smooth the pain with easier conditions. So if you're waiting for a clean moral ending where deficits shrink, debt falls, rates normalize, and purchasing power is restored, you're waiting for a fairy tale. Silver is for people who live in arithmetic, not fairy tales. Now I want you to engage with this, because your answer will reveal your strategy. Do you think the Fed can keep rates high without something snapping in credit or employment? Or do you think the first real break forces the pivot, no matter what the inflation data says? And second, if the pivot comes, do you believe it's a controlled pivot or a panicked pivot? Because controlled pivots usually move markets slowly. Panicked pivots move markets vertically. And silver loves vertical. But don't confuse vertical with easy. The market will try to scare you out before it rewards you. That's the entire game. First, shake confidence. Then, reprice. So here's the practical takeaway, the one you can actually use. Treat this rate signal flip as a warning light, not a lottery ticket. It tells you the macro environment is becoming more unstable, not more stable. It tells you that the bond market is increasingly skeptical of higher for longer. It tells you the Fed is inching closer to the moment where it must choose which pain to accept. And when policymakers have to choose pain, they usually choose the pain that is least immediate and least visible. They choose the pain of dilution. That is where silver lives. Before we close, I want to give you a simple watch list. 3 pressure gauges that tell you whether this trap is tightening or loosening without needing a PhD. Gauge 1. Real yields. Not nominal yields. Real yields. When inflation expectations rise or when policy credibility slips, real yields tend to fall even if nominal rates look high. Silver doesn't need nominal rates to collapse. It needs real yields to stop being a headwind. If you see real yields rolling over while officials are still acting hawkish, that's the market voting against the script. Gauge 2. Treasury demand. Watch how easily the government can sell its debt. When auctions get sloppy, when buyers demand higher compensation, when bid to cover weakens, when tailing becomes normal, that's the debt machine asking for a bigger check. And the bigger the check, the louder the pressure on the Fed to help, directly or indirectly. Gauge 3. The dollar trend. The dollar doesn't have to crash to change behavior. It just has to stop acting like the unquestioned king. If the dollar starts drifting lower while global stress is rising, that's a sign the world is hedging the system itself, not just a single crisis. Now connect the dots into 2026. If the economy slows and the Fed pivots, liquidity returns and silver gets the monetary tailwind. If the economy slows and the Fed refuses to pivot, defaults and unemployment rise, and the political pressure becomes a furnace, eventually forcing a pivot anyway. And if inflation stays sticky through that process, silver gets the worst-case fuel, easing into inflation. That's why today's signal matters. It's not buy now because magic. It's pay attention because the map just changed. Now, if you've made it this far, you're already ahead of the crowd that only reacts to headlines. On my channel, we don't chase noise. We track the pressure points. If this breakdown helped you see what shifted today, hit the like button so this doesn't get buried. Subscribe to my channel for more deep dives on rates, debt, and the hidden mechanics that move metals. And leave your answer below. Is the Fed trapped? Or do you think they still have a clean exit? And tell me what signal would change your mind.